Hey everyone, welcome to my first video for pattern trading. I'll teach you a little bit about patterns, how to trade them. Right now we're looking at the gold chart. As you can see, I have my 3 moving averages. I just use them as a reference. I don't trade specifically off them. The green has a simple moving average at 50. The orange, simple moving average at 100. Pink, simple moving average at 200. Now there's a strategy that I used to use for gold. It's pretty accurate, but there were some inconsistencies during very strong volatility, so I kind of left it behind in favor of pattern trading. But the strategy that I used to use is when you had pink, orange, and green in descending order, and then green came up and crossed over orange, that was time to place a buy. And at that point, as you see from there, it would go up. But the issue was generally with when to exit. So I kind of left that behind in favor of pattern trading. Alright, so for gold, the first pattern I'm going to tell you guys about is the double top and double bottom. Now we have a beautiful example of that right here in this one chart. So we're going to draw a trend line. You see you have a double top here. When you have a double top, generally that means it's going to change into a downtrend. When you have a double bottom, that means it's going to change into an uptrend. Moving over here, I'm going to show you the example of a descending triangle. Sometimes you'll hear me refer to this as a flat top if it's a bullish, or a flat bottom if it's a bearish. But you have your bottom right here, and you have your trend down right here. As you can see, this is a pattern that indicates it is going to go down. This is what's referred to as the flagpole, and then this is your flag right here in this triangle. Switching our chart over to the daily view, on gold, it loves to follow these patterns. You'll see them everywhere. On the daily chart especially. It's very predictable. It's easy to trade it. You just have to have patience. If you're trying to be in a trade constantly, then you're going to wind up losing. But if you have patience and wait for it to come to you, you'll do great. Now we're going to go ahead and draw some examples. We have this guy right here. Got our resistance, and we have our support. This pattern, where you have a wider section and then it gets closer and closer, is what is known as a falling wedge. Typically when people hear the word falling, they think, oh, it's going to go down, yada yada. No. Falling wedge is a pattern of continuation. Look at what it was doing prior to entering that pattern, and it will continue doing that. So a falling wedge is indicative of it's going to go up. A rising wedge is indicative of it's going to go down. And you can see gold loves its wedges. I got one right here, huge increase, one right here, huge increase. And you can see right now gold is in a channel. Now, a channel is different from a wedge in that it is relatively the same distance. It doesn't get closer together at the tip. A channel is a pattern of continuation as well. It's just going to take a lot longer to get there. It's got a much wider range between the resistance and the support. With a channel, you can usually find a good midline. We're going to say our midline is right about here. If I see that it's in a channel on the daily, and it's been respecting it for quite some time, anytime it's above the midline or close to the top resistance, I'll put in a sell, or I'll take profit on a buy that I had earlier. If it's near the bottom, I'll take a buy. I believe I posted in the chat earlier a buy that I had right here, but so you see we got a double bottom that we marked earlier. Here's the double top that we marked earlier, and it's heading towards that midpoint. What I would do if I was still in the buy from the double bottom is I would take profit when it got around that midpoint, and then I'd watch and see what it did. I'm going to briefly take a closer look at the falling wedge, so you know how to trade it, basically. So with a falling wedge, you've got your top resistance, and you have your bottom support, and it will vacillate between the two. When it starts to break out, that's when you want to watch it. While it's still in these lines, don't worry about it. Don't even try to trade it. Wait for it to come to you. If you want to try to trade it, then you'd place a buy near the bottom, take profit near the top, etc. Little scalping movements. But key here is patience, because as you see, this went from February to May of 2019. When it breaks out, if it dips back in, that's your pullback. You have a breakout, people start buying, pullback, the bears are trying to push it back down in to drop it below. Once it comes back out again, it'll try to test that top support. As long as that top support holds, that's your time to buy. Another personal favorite of mine is the cup and handle. Cup and handle is pretty easy to trade. It's relatively easy to spot. You've got your neckline of resistance. Okay. See the top drops down, comes up, drops down, then breaks out. This is your cup and this is your handle. The handle is generally around 35 to 50% the depth of the cup. How do you trade these? Simple. You've got your neckline. When you see it's formed the handle and it's working its way back up, you can place a buy limit for just outside of that neckline. What's your take profit going to be? To figure that out, you measure the depth of your cup. Figure out how many pips is between the bottom of this cup and the neckline. Add that number of pips from the neckline to get your take profit. In this case, the depth of the cup is $170, which equates to 17,000 pips. So you would add your 17,000 pips to this, and you get a take profit target of 1520. So 1,520. So our take profit price off trading this cup and handle would have been right here, which, as you see, was the end of that bull run. Beautiful, ain't it? And at that point it switched into a new pattern, which we can then trade. Another pattern we're going to take a look at here is called the head and shoulders. Hold on one second. Stop that. There we go. Alright, so we have a head and shoulders right here. A head and shoulders is where you have a hump on one side, a bigger hump in the middle, hump on the other side. So you find your baseline, which is right about there. Doesn't have to be exact, but gives you a general idea. Alright, so head and shoulders is indicative of reversal, generally. As you see here, there's left shoulder, head, right shoulder, and from there it then went down. To find out how much it should go down, you get your top, go down to the neckline, figure out how much that is. It's a difference of about $4,000. So then you would subtract $4,000 from here, which is around 51. Let's see, it's 55,110. Subtract 4,000 from that would take us to about 51. Yeah, 51, 110. 51, 110. Look at that. It's right here. Right here at the bottom. Easy peasy. And that's using patterns. You can also trade Bitcoin as well. It's great for that. Bitcoin and gold are both commodities, meaning that they only trade against the US dollar. If you've done Forex trading before, you'll know that a lot of them are currency pairs. You've got like the Great British Pound versus the US dollar. So then you got two economies affecting the price. With gold and Bitcoin, it's just one. So they love their patterns, they will follow them, they will stick with them, and they'll respect them. We use the example of a bull flag quite often, and generally in the chat you'll hear me mentioning bull flags a lot. So I want to take some time to really look at this one. You draw your trend lines off the top, draw your support line off the bottom, resistance on the top. Now, a bull flag is when it's coming out of a bullish movement. A bear flag would be if it was coming down and then did this. Bull flag is coming up and then forms the flag pattern triangle. When it breaks out, what it's going to try to do is it's always going to want to test that support again, because this used to be resistance. Once it breaks past it, it's now support. It's got to test it. And sometimes we'll test it once, sometimes we'll test it a bunch of times, and then you've got your previous support coming up in a nice little line here, so you'll see it bounce off of that as well. It's the movement that we are seeing currently on IVR. Sometimes you can run into the case where it goes into consolidation for a while. It'll break out and then it will fall back in between these two again. Don't fret when that happens. As long as it respects this trend line, you're good. Eventually it will get back up there. But so we have our bull flag, breakout, test support, and up and away it goes. To figure out your price target for bull flags, measure the mouth of it, add it to the tip, and that's your price target. Now, I know a couple of you have heard about me talking about how Bitcoin is getting kind of close to its top. I believe the price target that I put in for this bull run before some form of correction was about 70 to 74,000. I'd have to look back at my notes. But here, let's look at why. Why do I say that? So first, I'm going to mark a previous pattern. And again, this is on the H1, but you can see these on the daily as well. But again, Bitcoin follows its patterns. But the big one that concerns me is currently forming. I mean, I guess it doesn't really concern me because we know it's coming. So, but this is your falling wedge, which indicates it's going to go up, and then you have your rising wedge, which is indicative of it going down. So let's take a look at this on the daily. Now, falling wedge would price target around 42, 45 for its correction after it completes. But in order to actually, I mean, my chart won't go up that high, but these end at around 70, 75, 76, right around up here, at which point then it would fall down. Because I don't know about you, but anything that looks like this on the monthly chart probably isn't sustainable for too much longer. Before we wrap this up, because I don't want to make a ridiculously long video, a couple of things to remember. Just draw your trend lines from the tops of the wicks, not the body of the candles. It'll give you more accurate representation of what pattern is forming. And don't be afraid to, if you draw a trend and then see that it adjusts a little bit, shift it. Because the market is fluid. It's not 100% solid, so you need to be dynamic with it. Have patience. Most of your best trades are going to come off of the daily chart or the H4. The lowest I will go with a trade is M30. You can still clearly see the patterns on, let's get to the end, there we go. You can still clearly see the patterns on M30, but you need to be able to see those patterns. You need a bigger picture. If you're sitting there trying to trade on the M1, then you are going to have a bad time, because everything is so minute. Little things, little movements, you're not going to be able to catch the bigger picture. So M30 should be the absolute smallest one that you're using. I prefer H1 and H4. I keep an eye on the daily trend to know the overall picture. So stick with your higher time frames. Don't try to trade every single day. You wait for it to come to you. I take maybe 2, maybe 3 trades a week on a pair. So I'll trade Bitcoin and gold so I can snag up a couple extra trades a week, but be patient. That's all I can say. But yeah, best of luck, and if you have any questions, you know where to find me.